So, hi everybody. It's a solemn day. It's November, not November, September 11th. I wish it was November. And now I know most of you are too young to remember this, but I was on Wall Street during September 11th, and I got to tell you, I still have PTSD about it to this day. But that is, so I'm wearing black in mourning, but it is what it is. Thank you, Angeline, for that great introduction. I think that it's amazing that we have so many people signed up for our inaugural investment competition. I'm really proud of what's going on. I'm really happy about all of this. And I'm glad there's so many teams involved. And by the way, the website looks great, Angeline. I think you're doing a fantastic job with that. I'm glad there's so many YEFA clubs that are opening all around the world, not just in the US, but in overseas locations as well. That's wonderful. So, now, if you click in the chat, please everybody get on the Discord server so that we can stay in touch and you can get real-time information. There's a YEFA Discord server, and I think there's one for this investment competition as well. The YEFA one is fun. I mostly post financial memes because, you know, it's funny. It's funny because it's true, and you post a lot of funny stuff, funny pictures and things like that. But a lot of the other students are very serious in there, and they're talking about how they're promoting their particular club and their particular location. They have a weekly talk also that's usually on Wednesday, I believe, after the market close, where they talk about what stocks they're picking and things like that. So you can get involved in that conversation directly. Close to 200 teams already joined the investment competition. That's great. That's really wonderful news. Very good. I'm really glad to hear that. All right, so I've got some slides that I'll share with you all today. I don't want to take up too much of your time, but I think what we should do, maybe once a week we get together and just sort of review the news about what's going on and what's making stocks go up or down, and what might make stocks go up or down in the future, because ultimately that's what makes us good stock pickers. We have to have a good understanding of what's going on and why. If we're just looking at stocks and saying, "Oh, I don't know what's going on," that's not helpful, right? There are usually reasons why stocks go up or down. Either earnings are going up or down, growth is accelerating or decelerating, or there's some macroeconomic news that leads investors to believe that earnings are going to accelerate or decelerate for a particular sector or a particular industry in the future. So let's just get started. I'll do this every week with you guys. We'll just do like a week by week update. We'll talk about topics that are affecting the market in this particular week, and we'll watch a couple of videos, and then that's it. So it'll be brief, it'll be fun. I hope you guys enjoy it, and I hope it's going to be like a news synopsis for you. So I hope it's not going to be tedious. All right, so let's get started. I got some slides to share with you. So welcome everybody to our inaugural investment competition for YEFA. Our focus is sustainability. And so in this particular competition, I think the first round cutoff to make it to the midterms into the semifinals it's pure stock performance. So after that, though, there will be a judgment panel where we're looking at not only your performance, but your focus on sustainability. So keep that in mind the whole time. Don't forget about that. But enough about that. We'll look at the specifics in a little bit, and maybe Angeline can address the specifics for this investment competition after I'm done with my slides. Because when I'm finished, I think what I'll do is I'll flip over to StockTrack. By the way, StockTrack is a widely used trading platform. We use it for all of our competitions. Other competitions use it as well. If you're going to do any other competitions like DECA, for example, you're going to want to learn how to use StockTrack. This competition is going to be not only the best competition for you because you can make money, but if you want to do another investment competition, it's going to be good training for you and good practice. So I wish you all the best of luck in our inaugural investment competition. But let's get started talking about what's going on with the stock market. So first of all, it's been a brutal bear market recently. And the reason is because the stock market is a discounting mechanism. If you look at the current economic indicators, it would appear that the economy is in pretty good shape. Unemployment is pretty low. Employment levels continue to grow. Household incomes are going up. but there's really high inflation. And when that happens, usually that can lead to an economic downturn. And so that's kind of a concern. And if you've taken one of my classes, you've heard me say this a million times, that there can be demand destruction, which kind of creeps up and you don't recognize that it's coming until it hits and the recession is there. For example, let's say you buy 10 widgets every day at the store for $1 each. So you spend $10 a day to buy these 10 widgets that you use for your business, whatever, you're a painter and you need these widgets. And then the price is going up because of inflation. And suddenly the price of each widget went from $1 to $2. Well, you still go in and you buy $10 worth of widgets every day, but you're only receiving 5 widgets instead of 10. Now, does that show up in the economic data right away? No, it does not. It shows that you're still spending $10. It shows that retail sales are solid, consumer spending is solid, and the economy is fine. You're receiving half as much as you used to. Well, so that's bad for you and your business, first of all. And second of all, it's really bad for the guys and girls at the widget factory, because suddenly they only need to produce half as much product. Inventory is building up on the shelves. They have to lay off a whole bunch of people. And that's how this sort of thing gets started. That's how inflation can directly lead to demand destruction, and in a very sneaky and insidious way where you don't see it at first, because all the economic indicators look pretty good until suddenly it hits you that people are getting laid off and losing their jobs, and therefore retail sales are down, consumer spending is down, and factory production is down, and everything starts falling apart. And that's what happened in many countries around the world. And it happened here in the United States in the 1970s, where we had what was called stagflation, where we had stagnant economic growth, in fact, negative sometimes or flat, but with profound inflation. And the inflation is the part that was hampering economic growth. And finally, the government realized, well, if we're gonna get the economy back on track, we have to have a stable currency again. And they tried their best to stabilize the currency by raising interest rates, getting inflation down to almost zero, and then proceeding onward. And that worked. It worked. But now we're in an environment where we have really high inflation. Every consumer price index report that comes out is monumental, not only for the economy, but for the stock market. So every time there's an inflation report, we have to pay very, very close attention. It's very important. The Federal Reserve obviously is tightening interest rates in order to combat inflation. And this is having a profound impact on the economy and the stock market. So to get back to where I started this, the stock market is a discounting mechanism. The economy is doing well and earnings have been okay so far. I mean, for some companies, they haven't been. We've already seen demand deflation, demand destruction in several areas, particularly in retail stores. And we've seen pre-announcements from Target and Walmart and even Amazon. But that being as it may, the rest of the economy seems to be doing okay. But the market is down because it's anticipating that this economy is going to get worse. It's either going to get worse on its own because of inflation, or it's going to slow down because the Federal Reserve is going to continue to hike interest rates. Now, there's a brief period, and let me flip to this next slide. Yeah, so here's our year-to-date chart. And as you can see, we've been in a horrible bear market until about June, right, where things were just rolling over lower and lower. A couple bear market rallies, lower rally, lower rally. This was the latest bear market rally where everybody thought, hey, everything's great again. And you know what? The sooner the Fed raises interest rates, the sooner they can start cutting interest rates next year and things are going to be great. So let's start buying stocks now, until they realized that was simply not going to happen. The Fed is not going to start cutting interest rates. They're going to continue to hike interest rates. They've made that very clear now, and they're going to hold interest rates higher, probably above 4% for quite a while, until the inflation genie is stuffed back into the bottle, so to speak. And I know that's a weird metaphor, but as you know, once the genie's out of the bottle, you can't get it back in. It's really hard. So they're going to have to do a lot of work in terms of raising rates and holding them higher until inflation gets down to the target 2% rate. for the longest time, they absolutely failed at hitting that 2% target. Inflation was 0, which is fine, or it was slightly negative, which is not good. We don't want deflation either. That's worse than inflation, actually. But they, were pretty consistent about being in that 0 to 2% range for years and years and years. And then we printed too much money. How much money did we print, you ask? I don't know. Let's find out. I didn't even do a slide on this, but let's go find out, guys. Let's go see what's going on over here. Let's go to FRED, which is the Federal Reserve Economic Database maintained by the St. Louis Federal Reserve. And let's look at the, they even have a tab right here for the M2. Let's look at the money supply. So let's check it out. Yeah, we suddenly just printed a ton of money and then continued printing money. Oh, and now look, the Fed is actually tapering its balance sheet and things are flattening out. Oh, and you wonder why inflation is slowing down. Well, they're sopping up all that excess liquidity. The Federal Reserve had not just printed money. I mean, the government itself prints money, as you know. They buy things that they don't have money for. But the Federal Reserve, in addition, purchased a lot of bonds, including treasury bonds, including mortgage bonds. Let's look at the M1. It even looks more stark when you look at the M1. The M1 is the money supply. See, that just looks ridiculous. This is a better chart, so it's more demonstrative of what I'm trying to explain to you. But it also shows a more tightening here going on, which is interesting. The Fed, I hadn't looked at this in a few days, and the Fed's getting things under control now. So yeah, we printed way too much money to maintain the economy during COVID. And because of that, we have a lot of inflation. And now the Fed is trying to not only tighten interest rates, but it's tightening its balance sheet. All of those bonds that it had purchased, treasury bonds and mortgage bonds, they're letting them mature. And when they're maturing, they're not repurchasing new bonds, so essentially what happens when they bought those bonds, they didn't have cash to do so. They just made it up. They made up cash and said, here you go, here's cash for your bonds. And so a lot of money was injected into the economy. And the good news is that enhanced liquidity in the credit markets. So we didn't have the same thing that happened during the financial crisis in 2008, 2009. But consequently, it did trigger a lot of inflation. So now they're sort of letting those bonds mature. And when they mature, the people who borrowed the money have to pay it back to the Fed. So that money essentially disappears out of the economy. And you can kind of see that at that crest right there. And things are they're coming back down, which is one of the reasons why, as I'm sure you've noted, inflation is not at 8-9% right now. It's starting to come back down a little bit. We're not printing as much money. In fact, we're taking money out of the system. So that's good news. That's the good news. The bad news is we're not at 2% yet. And so the Fed is going to continue to tighten and continue to tighten and continue to tighten. So it's going to be a really tough time for the stock market right now, unfortunately. So let's talk a little bit about why stocks go up and down. Now, if you've taken classes with me, you know the answer. There are two main reasons. When you buy a stock, what are you buying? Well, yes, you're buying ownership of the company. You're an owner of the company. That is true. But the reason you want to buy ownership of the company is for the earnings. So we have to constantly pay attention to the earnings calendar. And the other reason, of course, is because our expectation of future earnings. Remember, stock market is a discounting mechanism. If it thinks earnings are going to be worse in the future, stock prices are going to go down. And that's kind of what we're seeing recently. What we're seeing is the PE multiples have come down from 22 times on average to 20 to 18, now getting to 16, because the anticipation is that the growth is going to decelerate. But what we haven't seen yet really is the earnings revisions lower. And that is what's scaring people right now and causing the PE multiples to come down. If we start seeing companies report bad earnings, not like really bad earnings, and we're starting to see some companies they'll give you a decent earnings report and say, we don't know what's going to happen next quarter. We have no visibility. And look, I've been through this cycle several times, in 2000 and 2008. It starts the same way every time. Companies start reducing their guidance. They start saying they really don't know. They withdraw their guidance and don't issue any new guidance. When companies start doing that, you can expect that their earnings are going to come down. And so it's easy for us to say, well, yeah, stocks are trading at 22 times and now they're trading at 16 times. They're cheap, but they're not cheap because we've only reduced the P of the PE ratio. We haven't reduced the E. We've reduced the numerator, but we have not reduced the denominator. But the denominator might get cut in half. And if that happens, your 16 suddenly goes to 32 and stocks look expensive again. So stocks could be really expensive here. It depends on what the future earnings come out as. So we have to keep an eye on earnings reports. So let's just look really quick at what happened over the past week. We're sort of through earnings season. There's not a whole lot going on, but there are a couple of interesting companies that reported. And so what we see here is a couple of companies that have no earnings or they're losing money. And so that's the kind of company you don't want to own in an environment where the cost of money is accelerating and interest rates are going up and the cost of equity is going up. These are companies that are going to have to conserve their cash and not accelerate their burn rate until they get to at least cash flow positive or profitability. And that might take a long time for some of these companies. Like NIO is a new company. You might be familiar with it. It's an EV type company, but it's not profitable yet. If it needs to raise another round of funding, could be really expensive now. Could be a down round. Who knows? Copart, that's an interesting company I'm familiar with. They actually beat. That company's been around for a while. And then we've got our meme stocks like GameStop. Look, they beat. Okay, so they're expected to lose 38 cents a share and they only lost 35. Hooray! You can't be a company that's losing money in this environment. The economy's not getting stronger, it's getting weaker. Money is not getting cheaper, it's getting more expensive. Debt is getting more expensive. Equity is getting more expensive. I didn't even look at this, but since we're here, let me just flip over here and take a look real quick. I want to see exactly what happened to GME when they reported this past week. Because honestly, I'm curious. I'd kind of like to see. Wow, it's up a lot. So yeah, so the earnings beat. Okay, so they didn't lose as much money as expected. That's interesting. Now, this earnings report came out on Tuesday, so the stock went down a lot, but then at the end of the week, it rallied. Now, this is interesting. Janet asks in the chat, is this topic to all the students or their parents? Well, whatever, if you guys want to learn how to invest and talk about the market, we can invest and talk about the market. Parents can join in too, but it's mostly for the students. I think most of the students have taken classes with us in the past, and so they know a little bit about how this works. I think some of the parents do too. I'm sure some of the parents are trading professionals and you know a lot about how this works. So yeah, you're all welcome to join in and talk to us. Yeah, it's mostly, yeah, exactly. Thank you, Angeline. It's mostly for the students who are in the investing competition and are trying to win the competition. So we're going to do a market update every week and talk about why stocks are up or down. So here's a case where this stock is losing money. It has a negative EPS. It's not forecast to have a positive EPS. It doesn't have trailing 12 months lost $6 a share. Let's see what the forecast is for the next year. Negative $1.37, but getting down to negative 84. All right, so things are getting less bad. So that's interesting though that they missed they beat their earnings, but because they lost money, the stock went down on Tuesday, and then by the end of the week, people figured it out and the stock went back up. Very interesting. Okay, so let's get back to talk about the next couple of earnings reports. So that was everybody's favorite meme stock, GameStop. Interesting company. So let's see. That was actually Wednesday. Thursday, not a whole lot going on. But again, what the problem is we've got a lot of companies that are tech companies. Zscaler, DocuSign, Bilibili. I like Bilibili. Don't get me wrong. But the problem is they're expected to lose 77 cents a share and they lost 85. DocuSign was expected to lose 9 cents and now they're losing 18. That's 100% decline. It's 100% negative earnings surprise. Zscaler, the story is a little bit better. They did better than expected. But still, we got a situation here where companies that can't earn money they're kind of in a financially disadvantageous place. Now, interestingly, we have another. I didn't even notice this. A couple of my favorites are on here. All right, so Restoration Hardware, now known as RH. Now, this is interesting because they kind of sandbagged their guidance. They were expected to earn 681 and they earned 808, which is great. But then they sort of sandbagged their guidance and said, yeah, things are softening and they're not that great, which is, it's honest of them to say that. It's better for them to underpromise and overdeliver than the other way around. And so, their stock always gets beat up when they're honest like that. But the reality is the economy is just not getting better. It's getting notably worse. And then, of course, my all-time favorite that I analyze for every class that I teach, National Beverage, which serves LaCroix sparkling waters, or LaCroix, however you want to pronounce it, LaCroix. They were expected to earn 57, and they missed by a third, and they only earned 38. Now, again, this is now I have to read the earnings report, so I update my models for my classes. But as we know, because you studied class with me, this is one of those companies that gives no guidance, and it's completely unpredictable, and it's hard to figure out how much they're going to earn and how much they're not going to earn. So anyway, the earnings expectations are moving lower at this point. We see a lot of negatives here. There were a couple that were positive surprises, yet the company still lost money. So that can't really be considered that positive, right? I mean, yes, the company's losing less money, but it's continuing to lose money. So all week, there weren't that many companies that reported earnings, but the earnings they reported were not that great. Normally, companies don't report on Friday. So the exception to the rule was the Kroger company. And I tell you what, the interesting thing about grocery companies is that inflation is remarkably good for them because they have a lot of stuff in inventory and they paid something for that stuff. But now if there's inflation, they can raise the price of that stuff when they're selling it to you. Those canned goods that they paid 20 cents a can for, now they can charge you 50 cents a can, and suddenly they're making a huge profit margin. So this is one area of the stock market, and believe it or not, it's like the most boring one, but believe it or not, it's the one that does really great during inflationary and recessionary periods. Grocery stores, because people don't stop eating food or drinking beverages. They just don't. In fact, if inflation gets bad and the economy gets bad, they're going to eat the same amount, but they're not going to go out to restaurants. They're going to go to where? The grocery store. So Kroger was expected to earn 84 cents and earn 90 cents, a big surprise for them, nice upside. And again, this is one of those companies, when I covered this industry, I can remember during inflationary periods, that's all they could talk about is inflation is good for this industry. We've got so much inventory in our warehouse, so much pasta and canned food and stuff like that. Now look, produce, you can't mark up and make double your gross margin. But for all the other stuff, you can. Packaged goods, you can make a lot of money if you just start marking it up. So, and here's what happened to Kroger stock. You can see what happened at the end of the week. They reported on Friday. The earnings were a big beat, and the stock went from 48 up to 51, almost $52. And so that was a nice way to cap off the end of the week. And it sort of helped cap off the market for the end of the week too, because people could see that there are some companies that are still going to do well. There are a lot that are not going to do well. Let's face it. There are some companies, particularly tech companies, that they may go out of business, and we have to be very cautious when we're investing in those companies, particularly those companies that have no profits or are negative cash flow right now. But What we can do though is invest in companies that are solid, that have good earnings, good cash flow, and growing earnings. If they surprise to the upside, those stocks are going to continue to do well. And that sort of ended the week, where we ended the week on an up note. The last few days, we had some good reports too economically. So like I said, it's not just the earnings that drive stocks up and down, it's the expectation of future earnings. And so we had a PMI report come out, and if you recall, we talked about this previously, but for those of you who haven't taken our classes, the PMI is Purchasing Managers Index. And it is one of the most forward-looking economic indicators because it's a survey. And what happens is, well, there are a couple different agencies that run this. This one's from the ISM, which is the Institute of Supply Management. They will call factories or service businesses and talk to the purchasing managers and ask them questions like, how much did you buy this month? How much did you buy last month? How much do you expect to buy next month? How many people do you employ this month? How many people did you employ last month? Do you expect to hire more people for next month or lay people off? You know, how are your sales this month? How are your orders looking for next month? And because they're comparing the current conditions to the previous and also asking about the future expectations, this is one of those indices that's really, really valuable in looking forward at the economy. And remember, if you took the class, you already know this, it's usually ranked, these kind of things are ranked on a scale of 0 to 100, where 50 is break even. So usually, you know, this thing will be trending around 50 and it won't go much higher or lower than that. Any reading below 50 means we might be in a recession, and any reading above 50 means we're probably experiencing decent economic growth. And the higher it is, the better, the more it is above 50. So let's see what the latest report looked like.
Yes, Carl, finally we get a number that's a bit of a beat. Our August read by Institute for Supply Management on the Services Index, expected to be in the vicinity of 55.3, comes in at 56.9, 56.9. And indeed, that is good news. 56.9 happens to be the best read going back all the way to April of this year. But considering May of 2020 is where the last service index was on the S&P Global, it's definitely a better number. And we see what's going on today. Whether you're looking at the euro currency, 57.6 of the dollar index at a 20-year low, or the yen at a 24-year low at 13.6% of the dollar index, and the pound near the lowest level since 1985 is 11.9% of the dollar index. We need to pay close attention, especially with 13 now basis points, 15 basis points on the day higher for a 10-year note yield. Leslie, back to you.
And the day is still young, Rick. Thank you.
That was actually pretty good news. So here's the chart on that, and you can see, let me turn my camera back on. You can see clearly how this works. Usually we're chugging along between 50 and 55. And when things started to slow down pre-COVID, because we knew COVID was coming, it went below 50. And then when COVID actually hit, deep drop down because we had lockdowns, but we immediately rebounded. And as the lockdowns ended, we recovered. Now, it's been worrisome recently because since the lockdowns have ended and everybody's gone back to work, things have been slowing down. And so the question remains, does this slowdown portend a recession? Well, certainly there's going to be a slowdown because we can't continue reopening forever. We're reopened. But the inflationary aspect makes it particularly troublesome because if we're going to have a slowdown anyway, plus we have an inflationary environment that could induce demand destruction, we could get into a recession. And see the ISM dip down to just about 50 right there. Well, luckily has bounced back. So it's a little better than expected. And, you know, it's one of the reasons we had an okay week on the market. It was brutal the first couple of days, but by the end of the week, things bounced back a little bit. So we also had a report out of the Federal Reserve. And this is the last we're going to hear from them for a little while because they're in their quiet period now until they make their interest rate decision. So there was a flurry of speeches. All Federal Reserve governors gave a speech somewhere this week, and they were all very hawkish, brutal. But they put out their Beige Book report, which reports on economic conditions in the different sectors of the economy in the different parts of the country. And I guess the most notable takeaway was that the price of real estate is starting to fall in every single part of the country. The last time that happened was 2008, 2009, which of course triggered the Great Recession and the financial crisis. Now, I don't think we're in the same boat as we were then, but nonetheless, it's a little bit scary, a little bit worrisome. But the Federal Reserve report, though, is basically flat. For half of the country, things were up, and for the other half, their things were down a little bit. So generally, it's sort of a Goldilocks report where things are not collapsing. They're holding steady. Inflation's starting to come back down. Interest rates might go up a little bit more, but we know that there's going to be a limit somewhere. And so here's what that report said. Oops, excuse me.
Tyler, thank you very much. The Beige Book, the collection of economic anecdotes from the 12 Federal Reserve Bank districts, says economic activity was unchanged over the course of the 6-week period. Usually they say it's modest to moderate growth. First unchanged we've seen in a while. Now, 5 districts say there was slight to modest growth. 5 districts said there was slight to modest softening in growth in their districts. Most districts did say the consumer spending was steady, though auto sales were muted. There was solid leisure and hospitality activity across the districts, though. Manufacturing did grow in several districts, but some manufacturing declined, and that was due to supply chain issues and labor shortage. Residential real estate weakened noticeably, according to the Beige Book. The growth outlook, however, remained generally weak overall for the U.S. economy. When it comes to employment, it rose at a modest to moderate pace. Labor market conditions remain tight, but one bit of good news here, there was some improvement in labor supply. The reports of slowing wage growth in some places, but prices remained elevated. 9 districts, though, reported some moderation in the rate of price increases or inflation. There was substantial price inflation, though, reported across all districts, including for food and rent and other necessities. Some tapering was seen in commodity prices, and pricing pressures, however, according to the context of the Federal Reserve, were expected to persist through the year end. One little bit here, let me add, Michael Barr, the Vice Chair of Banking Supervision, the new Vice Chair, laying out his views on banking regulations, saying crypto-related assets activity requires oversight, and then this from the Federal Reserve and Bank Supervisor. He plans to work with other regulators to ensure that crypto activity inside banks is well regulated. He said he's committed to a safer and fairer banking system. Courtney?
Thank you, Steve. I have a question. I guess the residential real estate weakened noticeably, and that one stands out to me because I know so many recessions or economic downturns have a very important real estate component, and the weakened noticeably stands out to me. What do you think of this? Well, it stood out to me too. That was one of the more, what do you want to say, demonstrative comments in the Beige Book. I'm trying to see if there's any other detail around it. Not that I'm seeing here. Residential loan demand was weak amid elevated mortgage interest rates here. Commercial real estate also softened. But I'll read you what it says. Despite some reports of strong leasing activity, residential real estate conditions weakened noticeably as home sales fell in all 12 districts, and residential construction remained constrained by input shortages. So there's 2 parts to that story there, Courtney. And you're right to focus, I think, on what's happening in the housing market. We had several analysts on our air describe what's happening in housing as a recession. It doesn't appear as if the rest of the economy right now is in recession. But of course, autos, which were muted, and housing are 2 sectors that are often pointed to as the most interest rate sensitive.
Yeah,
Shepard Smith here. Thanks for.
This is why we have to pay attention to these economic reports, because as we're deciding in which sectors to invest, in which industries to invest, in which stocks to invest, we have to pay attention to these forward-looking indicators. Clearly, housing is in a bit of trouble right now. Autos also maybe a little bit soft. Might not be the best time to buy auto stocks. Maybe it's going to be time to wait, sit tight. It might be time to just wait for things to get better, for interest rates to stabilize, for unit volume sales to stop decreasing, maybe stabilize. And then when it begins to increase again, maybe that would be a good time to buy the stock of Ford or GM or Tesla or any of your other favorite auto stock. Same goes for the home builders. Clearly, the rise in interest rates is having a negative impact on loan demand, which means home sales are going to be lower and home prices may be lower as well. So I want to highlight this particular comment from Lael Brainerd because, like, when we had this bear market rally a month ago, it was just silly because I know that investors were thinking, well, things are not getting that much worse, and here's what's going to happen. The Fed's going to raise interest rates and then stop, and then next year things will be slowing down, so they'll cut interest rates and stocks will go back up. Well, Lael Brainerd, she is the most dovish of all the Fed presidents, and she's the vice chair. She's the vice chairperson. And she came out this week and said that they're hiking, and they're going to stay high interest rates are going to stay high for a long time. So interest rates will need to rise further, remain there for some time, says Vice Chair Lael Brainerd. So yeah, they're probably going to raise by 75 bips. They're going to get up. It's probably going to get up to 4%. And that's going to be bad for the stock market and bad for the economy. But when you have the most dovish of the Fed chair people, the dovish of the Fed presidents talking about how they're going to hike more and hike higher and stay there for longer, you better bet that that's what's going to happen. They're not going to screw around with that. Okay, so for retail stocks, for those of you who are investing in retail stocks, consumer discretionary in particular, autos, hotels, lodging, airlines, handbags, luxury goods, things like that, we got to look at things like unemployment levels. And so here's one of the final reports that come out this week. And this one is really one of the most forward-looking. I know that generally people like to look at things like the unemployment rate. However, the first-time jobless claims number leads the unemployment rate by a significant amount of time. And the unemployment rate, of course, leads the GDP indicator by a significant amount of time. If you follow the leading indicators, you can see where the lagging indicator like GDP is going to go up or down. The concern recently, and I'll show you a chart in a second, has been that the leading indicator, the first-time jobless claims, has been trending higher. Usually when that happens, it portends a recession. If first-time jobless claims start increasing and continue to increase, then the unemployment rate will go up, which will lead to, of course, widespread unemployment, as I'm sure you might imagine, and that will lead to a decline in GDP. The economy will go down and we'll be in a recession. So it's really important that we look to these leading indicators, not just for our day-to-day stock picking, but for our overall market strategy, because this is going to tell us if we're going to be in a recession and for how long and how bad it's going to be.
Yes, on initial jobless claims, we dropped 10,000 to 222,000. That is the lowest level on initial claims going all the way back to the last week in May 27th, when it was 202,000. And if we look at continuing claims, 1,473,000 going the other direction. April Fools, because that's the last time we're up at these levels with regard to continuing claims that have been, for the most part, a little better behaved. But over the last several weeks, initial claims have really dropped and call into question the whole notion of how this tight labor market ultimately is going to figure into how investors and economists handicap the economy. We all know Jason Furman wrote an op-ed today talking about slack in the labor force being one of the critical tools that the Fed is going to continue to use to try to assess the level of pricing pressures. So these are very important issues. We all saw what the ECB did, and their yields are barely higher after a lot of volatility. Maybe it wasn't widely expected by everybody, but all traders I talked to thought that Lagarde had very little choice but to go fast and go hard. And with respect to its impact on the market, all our yields, Becky, from 2s out to 30s were lower again today until the volatility of the last 45 minutes or so, which has 2-year and 3-year notes going in and out of negative and positive territory with respect to their yields. But I would continue to stress that we have turned the corner a bit after that August 26th speech of our chairman of the Fed. Interest rates and equity markets, of course, thrown into a tizzy that seems to have moderated to some extent. Back to you.
All right, Rick, thank you. Steve Leisman joins us right now with more. Steve, what do you take out of these numbers?
Yeah, Rick is right to point out this difference, which is interesting between the continuing claims and the weekly claims. And I'm looking here. It looks like continuing claims are up by about 1 million, if I'm right here, 1.3 million to 1.47 million, a little bit more than that, actually, which tells you that people are being laid off and spending a little bit of time in the being jobless before getting rehired. But the inputs, the weekly inputs to the jobless claims numbers are low, and it suggests the job market remains tight. The Fed wants to see a softer labor market. The Beige Book yesterday suggested that there was maybe some softness, but not a whole lot in an overall tight labor market. The question is, as Furman raises and everybody else here, how much softness do we need in order to get inflation under control? I still believe that putting people to work is sort of not inflationary. I think it may help with the inflation problem in the sense that it would increase supply in a lot of areas that are short of supply, both in the service sector and in the goods sector. So it's not clear to me that that is an inflationary problem, but certainly the Fed wants to see softer labor market. Joe?
All right, well, that's an interesting take. So here's the chart. So this is one we really need to keep an eye on, because this is one of the things that sort of led to the bear market this year. So as we started reopening, the first time jobless claims rolled over and went really low, and everybody went back to work. But suddenly we hit the bottom, and first time jobless claims started trending a little higher. And when you start seeing that, it usually goes in that direction. And when that happens, you're in a recession before you know it. And so you got to watch this number, because that's going to lead them. It's obviously one of the things that's been spooking the market. That's why we've been in a bear market. It's not just that there's inflation. It's not just that the Fed is raising interest rates. Yes, those two are very important parts of this puzzle. But the first time jobless claims is another important part. Now, the fact that this is turned around and is going lower at the moment is a welcome relief. And I believe is one of the reasons why the market rallied at the end of the week, because it would appear that maybe we're not going to go into a deep recession. And maybe if we're lucky, the Fed will get it right. They'll get inflation back under control and the economy won't crash. And so the stock market had a pretty decent rally in the last couple of days. Does that mean it's going to continue higher? I don't think so. I mean, we're in a bear market for a reason. We still have problems we got to deal with. All right. So I would be cautious if I were you. Yeah, if you can't see the screen, Sean, yeah, I think everybody else can. I'm sharing the screen. So, all right, so let's change topics now and get off of earnings and get off of economics, and let's look at our stock track account. So I'm gonna switch the screen share right now, and I'm gonna go over to stock track. Let's make sure, because every time we have one of these stock picking classes or competitions, people have a hard time logging in, and I want to make sure that everybody's logged in. So let's see. Youth Sustainable Investment Challenge 22. Here we go. Let's see what we got. All right, no trades yet. Good. I didn't want anybody cheating, so that was good. We've got a total of 40 registrations. All right, so we have what, 200 teams signed up? So I'm going to go over a couple of things we need to know about stock track. Now, for most of you who've taken classes with me before, you've already done this and you know how this works. But I'm going to talk a little bit about how trading works on stock track, and we'll talk about some of the order types like market trades and limits and limit trades and stop. I would call them stop loss orders, but you have trailing stops and things like that too. So in case you've not done this before, please watch this, and then I will demonstrate in our stock track demo account.
To trade stocks or ETFs on StockTrack, go to the main menu under Trading and click Stocks. This will take you to the Equities Trading Pit. From here, first select your order type, whether you want to buy, sell, short, or cover. Next, input the symbol of the company you want to buy. If you don't know the symbol, you can just start typing the company name and we'll provide a list of symbols that match. Once you have a symbol put in, we'll provide you a quote, which includes the company logo and name, a current quote including the bid-ask price in today's range, a daily performance chart which you can expand into a bigger view, and we will also show you what the current analysts are saying about this stock and what the investment community is saying about this stock using StockTwits. From there, input the quantity of this stock you would like to buy, and click Preview to preview your order. Your order preview will appear above the analyst ratings. It will include the action that you're doing, the quantity, the order type, the target price if you're using limit order, the symbol, the current market price of the symbol you're trying to buy, and your commission charge. Your order preview will include all of this included. Click Confirm to enter your order. Once your order is processed, you'll get a confirmation near the bottom of the screen. You can then place a new order, view the order in your order history, or return to your dashboard. To trade international stocks, first choose the region that you'd like to trade in, and then from there select the specific exchange. After that, it's exactly like trading on the US exchange. Enter the symbol you'd like to trade and your quantity. The exact information available is different for each international exchange, as is the trading hours. For example, in London, we do not include the company logos, but we do include a performance chart. Please note that some international exchanges, like Ireland, only trade at the end of the day. This means that if you try to place a trade at any point during the day, you will always get a message that this market is now closed. However, your order will execute at the end of the trading day in Ireland. All of the prices shown on the quotes page are with a 15-minute delay. If you check the timestamp of the quote, you'll always see that this time will be 15 minutes before the current time. However, we execute all orders using real-time bid-ask prices. That means that the price that you see quoted on the trading page is going to be 15 minutes before the price that you actually get when your order executes. StockTrack includes liquidity rules. This means that the quantity of any stock that you're trying to buy needs to be less than the day's volume shown in the quote. This is because you cannot buy more of a stock in your portfolio in any day than has been trading in the real markets. If you try to buy more than the day's current volume, your order will place, but it will not execute. You'll be able to see it if you go into your My Portfolio in your order history, and it will appear as open. If this stock does get enough volume for your order to execute, it will execute. Otherwise, you will have to manually cancel your order to get your buying power back.
Okay, so that covers the basics, and that's really all you need to know. I know the last part, you've probably never experienced this before, but it is a real consideration. If you're investing $1 million portfolio and you're investing in a small cap company with a low share price, and you're trying to deploy 5 to 10% of your portfolio into that particular stock, if it doesn't trade that much, there's not enough volume, you will move the stock higher or lower. And unfortunately, that's going to work to your disadvantage. If you start driving the stock higher as you're buying it, and you're buying it at higher and higher prices, but investors attribute an intrinsic value. Let's say the stock's $5, and you start buying it, it starts going to 6, 7, 8, 9, 10, and you're still buying it. Now, if investors ascribe an intrinsic value to that stock of $5, and that's where it's been trading at $5, that's why it's been there. What happens is that as soon as you're done buying the stock, it'll go back down to $5. And you will have bought a lot of stock at $6, $7, $8, $9, and $10 that is now worth $5, and you will have lost money. So we do have to pay attention to volume. And so a lot of times what happens is you're going to want to limit your trades to a certain percentage of daily volume. For most of us, it's not going to matter. If we're buying large cap stocks, we can buy as much of it as we want, whenever we want, because they're very liquid. But if some of you start going into emerging market stock markets, emerging market economies, and buying small cap stocks and things like that, you could have a situation like they just described where your order is not going to execute because you can't buy more stock than what is actually traded. All right, so let's just recap order types real quick before we go for the day. I think this is the last slide I have. I want to make sure you guys are refreshed on limit orders and stop orders. And those are the opposite of one another. A limit order, to be brief, is where you set a price, usually when you're buying a stock, that's below where the current market price is. And the trade will not execute. You will not buy the stock until the price dips down below your limit. And when it does dip below your limit, it turns into a market order and automatically executes. Just to draw a little chart here, here's what we often see, and this can be a problem. If let's say the earnings report comes out tomorrow night from whoever's reporting earnings tomorrow night, I don't care, XYZ Corp. And the earnings were good. They beat on the top line, they beat on the bottom line, and they raised their guidance. And you want to buy the stock. Well, what's going to happen is the stock had been trading here and then is closed for the weekend. It's going to open up here. If you put in a market order, you're going to get this price. And believe me, the reason it opens there is because a lot of people put in buys over the weekend and drove that stock up. That's why it's trading there. A lot of people put in buy orders. And as all those buy orders are satisfied and the buying demand fades away, what's going to happen is the stock's going to start going like that. And basically what I'm warning you against is that you could find yourself in a situation where you make a good stock pick and you buy a stock and that stock could be up 10% of the day, but you bought it when it opened 15% higher and you lost money on that trade. And so if there's a situation like this, always make sure you put in a limit order because you don't know where it's going to open, right? If the last trade was here, maybe you put in your limit order somewhere around here because you know it's going to be higher, but you don't want to pay all of your money for this stock. You're going to wait till it comes back down, and when it does, then you buy it when it matches your limit order, your limit price, okay? It's really important to understand that concept. And the other one that's the opposite of a limit order is a stop order. And a stop order is usually used for selling. They're probably going to describe to you in this video how it can be used for buying, but I would kind of ignore that. If you're in a situation where stock's going up, and you put in a trailing stop, you're going to have like a running sell order that keeps going up whenever the stock goes up. That's going to be like $1 below the share price or 5% below the share price. And as long as the stock keeps going up, your limit order is going to keep going up. I mean, your stop order is going to keep going up. But as soon as the stock starts coming down and crosses over that stop, it's going to what we call stop you out. You're going to get stopped out. And it's generally described as a good way to prevent yourself from losing money. Sometimes you don't want to do it right away because if the stock is volatile and goes down, you're going to buy the stock at a high price, sell it at a low price, and maybe it's going to bounce back up. Who knows? But if you've got a good gain on a stock over the long term, and you're sort of at the point where you think the stock is fully valued and it might start coming back down, maybe put in a stop order, because if the stock does start coming down, you can lock in all these gains and avoid any future losses. Nothing wrong with doing that. Nothing wrong with doing that. The market order, of course, is the most basic. There's a bid-ask spread. If you put in a market order, you're definitely going to get the stock. It might not be at the price you expect, though. So stop orders and limit orders guarantee we get the price we want, but it does not guarantee that we get the stock at all, because in fact, it may not execute, maybe not ever, may never execute. We don't know. All right, so let's watch this real quick.
To make the most of your portfolio, you'll want to use limit and stop orders so your portfolio reacts automatically when the market moves. This tutorial will show you how to use these orders and how they work in this system. Limit orders are one of the order types you can use on this trading platform. They're used to maximize profit, but using a limit order will not protect you against losses. You can use both limit orders to buy and sell stocks. You can use a limit order to buy a stock when it's cheap. You'll set your limit price below the market price, and once the market price goes below your limit price, your order will execute. Let's look at an example. In this example, we're going to buy a stock with a limit price of $20. So you can see, as the stock price is moving throughout the day, nothing happens. But as soon as the stock price goes below our limit price, our order will execute. To use a limit buy order, first go to the trading page, enter the symbol you want to purchase and the quantity you want to buy. Next, change your order type to a limit order. Since I'm using a limit order, I want to enter a current price below the current market price. So if I see the price here is 9.65, I want to put my limit order at 9.50. That way if the stock price drops to 9.50 today, my order will execute. I'll click preview, which updates my estimated order cost to reflect my target price, and click confirm to place my order. You can also use a limit order to sell a stock. In this case, you want to sell a stock as soon as you think the price has gone as high as you think it will. That's where you'll set your limit price, above the current market price. This way you can try to maximize your profit. Let's take a look at an example. In this case, we're going to use a limit sell order set to $27. This is for a stock we already own. We see its price is moving up and down, but we'll wait until the price moves up above our limit price and the order will execute, getting us the highest profit that we set our limit for. To use a limit sell order, go back to the trading page and change your action to sell. Then, just like before, put the symbol and the quantity you want to sell and change the order type to limit order. In this case, I'm going to want to set my limit price above the current market price because I want to maximize my profit. So in this case, since the current price is 6.16, I'll put 6.25. I'll next preview my order, which updates my estimated cost based on my limit price, and click confirm to place my order. The opposite of a limit order is a stop order. These are designed to minimize loss. But like a stop order won't protect you against any losses, a stop order can make you miss out on some potential gains. For a stop buy order, you want to buy a stock as soon as the price starts to go up because you don't want to miss out on the stock's increase in price. This means you put your stop price above the current market price. Let's look at an example. In this case, we're putting in place a stop buy price at $25. This means when the stock's price starts rising, nothing will happen until it hits $25. When it does, our order will immediately execute, and we'll make sure we buy the stock before we miss out on any future gains. Stop orders work in the exact opposite direction of a limit order. So in this case, when I want to use a stop order, again, I type the symbol I want to purchase and the quantity I want to buy, and I'll change my order type to a stop order. Now, for a stop order, for a stop buy order, I want to put my limit price above the current market price. So I can see it's currently $1,232. So I want to set my stop price to $1,240. That way, if the price keeps going up today, it'll buy the stock for me. Press preview, confirm my order, and place it.
And we'll talk a little bit if there's any questions.
You can also put in a stop sell order. This means you want to sell a stock as soon as the price starts to fall below a certain point. You'll put your stop price below the current market price. Here's an example. In this case, we're using a stop price of $16. This means as the stock's price that we're holding is trading throughout the day, nothing will happen. But if the stock's price starts to fall below $16, our order will execute and the stock will sell automatically. A trailing stop order is a new kind of stop order. This tries to combine the profit maximization of a limit order along with the risk aversion of a stop order. Instead of having a set limit price, it'll lock in your gains as the price goes up. You can set a trailing stop order by a dollar amount or as a percentage of the value of what you're trying to buy. Let's look at an example. We'll use a $5 trailing stop order on a stock with a market price starting at $25. As the stock price falls, our limit price does not fall with it. But as soon as the stock price starts to go up, our limit price will start to go with that. This means that you can't lose more money with your stop order, but as soon as the stock price falls below your trailing stop amount, your order will execute. Like with the other limit orders, first choose your action, buy or sell, and then enter the symbol.
Yeah, he should have put sell in that box.
Enter your quantity for the number of shares you want to purchase, and change your order type to trailing stop order. In this case, you can have a trailing stop by a dollar amount or as a percentage. So for this case, I want to buy this stock if the price raises more than 5% today. That means even if it drops 10%, if it goes back up 5%, I will buy the stock at that limit price. I click preview and confirm my order to place it in the system. There are 3 types of order terms. Good till day, which means this order will expire at the end of the current trading day. If you place this order after the market closes, it will expire at the end of the next trading day. Good till canceled means that this order will stay open until you manually cancel it or it executes. And good till date means that this order will stay open until it executes or the date that you specify has passed. You can use any of the different order terms with any of the different order types except for market order. Market orders will always expire at the end of day. So in this case, I'll enter my symbol, I'll enter my quantity, and once I change my order type to a limit order, stop order, or trailing stop order, I will also see my order term. Good till day means that it's going to stay open until the end of today. If it has not filled by the time the market closes today, this order will cancel. If I place this order while the markets are closed, like if I set it at 5 p.m. Eastern time, then this order will wait until the next day, and then it'll try to execute all day tomorrow and then cancel at the end of tomorrow. Good till cancel means this order will sit open until either I cancel it or the conditions fulfill. So if you're using trailing stop orders that you want to have for a long term, you'll probably use a good till cancel order type. Good till date is a good till date. You can actually get a date picker where you choose where exactly you want this order to end. So if this date comes and goes and your order hasn't filled, then your order will cancel.
All right, all good advice, all good stuff. And that's the end of my prepared slides and prepared remarks. I see we have a few comments in the chat. Let's see what we have here. And now Zoom won't open for me. Lovely. Thank you, Zoom. You're the best. Let's see. Yeah, so yeah, some good commentary in there. Entered my age out of habit. I can change it. Yeah, you can change it. Does it allow after hours trading? Helen, the answer is no. You can enter orders after the market's closed, and it'll execute first thing in the morning or whenever your limit order is hit. But it doesn't do after hours trading, unfortunately. In fact, one of the things it was describing is that they're cheap. They don't even pay for real-time pricing. They get the 15-minute delayed free pricing out of the NASDAQ and the New York Stock Exchange, which is weird because then you have to wait for 15 minutes. Your trade will actually execute at the current price, but you're not going to see it for 15 minutes when you execute your trade. Can you change? You don't need to change your age. It's no big deal. So should your team have one shared account or a different account for StockTrack? And I'm pretty sure the answer should be that you should have one account for your team, because what's going to happen when you're doing different investment competitions, including this one, including DECA or whatever, you're going to want to have one account for your team. And if you have more than one account, you'll probably be disqualified from those other competitions. So it'd be best if you have one account for your team and one login, and everybody just use that one. That would be better. And so Sally says, no, it's pretty sure it's 9:30 a.m. to 4 p.m. That is correct. Those are the hours that the stock market is open in the United States of America, 9:30 a.m. to 4 p.m. Monday through Friday. There are 252 trading days per year, which is hard to believe, right? There's so many weekends and holidays. Instead of having 365 trading days per year, we only have 252. Oh, let me turn my camera back on. And so that's it. So what I'm going to do is I'm just going to go over here right now and just sort of highlight what they were doing just a second ago. If we're going to get started doing this, basically what you're going to want to do is you're going to go over to trading, and you're going to go to stocks, and you're going to put in the ticker. And then, oh, I already got a red bar. Tournament has not started yet. So I'm glad I showed those videos because I can't even demo how to do this because the stock market doesn't open until 9:30 in the morning, but our competition doesn't start until the 19th. So we've got a week from tomorrow. So get ready, get set, and go, because a week from tomorrow, everything starts, okay? All right, so that's it for me. Does anybody have any questions about how we're going to do StockTrack or how we're going to do trading or about market news or events or earnings or anything like that? Economics, finance? Oh, okay. If you guys don't have any questions, I mean, if you do, stick around. You can ask me in the chat, or you can just unmute yourself and ask questions anytime you want. Yeah, okay, thanks for being here, Adele. Thank you, appreciate it, everybody. Thank you, everybody. Thank you, Andrew. Elia, thank you. Bye-bye. Teresa, thank you. Bye-bye. Good seeing all of you. Daniel, thanks. Appreciate it. Sally, thank you. The PPT still aren't out yet? Yeah, well, that's true. I'll make sure they get posted, okay? So you guys can look at them later if you want. Victor, thanks for being here. Thanks, everybody. See you next time. Good luck. Good luck. Get ready for the competition starting a week from tomorrow, okay? So get ramped up, get geared up. We're going to make some money. Okay, bye-bye, everybody.